are you doing, Michael?
Good to see you, Gilbert. Thanks for having me at your conference this week.
Yes, finally to meet you in virtually. For some of the audience here, probably most of the audience, probably you're the first time being in this conference, maybe first time listening to your talk. Maybe I will start off by just talk about your background, because your background, for me, when I look at your resume, it's pretty straightforward. You spend quite a bit of time the company called Formula Growth in Montreal. And so why do you get into the investing into natural resources? Give us a brief sort of overview of your background.
Yeah, it's actually a great story, Gilbert. So I started investing in the late 90s, or 97, 98. I've always been a bit of a contrarian at heart. So when others are buying things, I want to buy the opposite quite often. So in 97, 98, when everybody was going crazy about the dot-com boom, not unlike today's AI boom that we're seeing, nobody wanted to invest in natural resource stocks. Nobody cared about the old economy stocks, the brick and mortar investments that kind of drive our economy. So I remember I was in a portfolio management program at university. 8 university students got to manage $1 million portfolio, and we had a vote one day on who's going to cover which sectors. And the technology sector came up, and 7 out of 8 hands all shot up saying everybody wanted technology. They're all fighting over technology. And then the energy sector came up, oil and gas, which is a big part of the Canadian economy, as you know. And nobody wanted the oil and gas sector. Zero interest. I said, okay, fine. I'll take the one that nobody wants. And back then, oil was $10 a barrel. The belief that oil was going to go to 5, it was worthless. And oil actually went from 10, as you recall, to $140 a barrel by 2008. So that was my first lesson in commodities investing. I had many stocks that went up 10, 20, 30 times my money. So from that day forward, I was totally hooked on A, investing in commodities, and B, buying commodities when they're out of favor or nobody really cares about them. That's often the best time to make really fantastic returns. So I've been a passionate commodity investor for over 25 years now because of that.
So having said that, you know this mining sector obviously is cyclical. We call it a cyclical business. So how do you mitigate? Because over the 25 years there will be ups and downs, and where are we at now in the commodity cycle? What do you think?
Yeah, it's a great question, and I've been speaking publicly on my other YouTube videos I've done recently on. I've been doing commodities for 25 years, Gilbert. I've never seen a setup like this before in my career. Usually, when a commodity like gold is making a new all-time high, $3,000 US as we speak, right? Usually the euphoria, the excitement, there's maybe 20,000 people at your conference, right? There would be so much interest in the sector. But the reality is, while the commodity is making a new all-time high, the interest in the sector remains very, very low, especially in the juniors. You have a bunch of really good quality juniors at your conference today, Gilbert. So the stocks are trading like the commodity is weak, but the commodity is actually very, very strong. So that's a very unique risk reward setup. The gold stocks might be trading like gold's $1,500 or $1,800 an ounce, but the gold price is actually 3,000. Usually, to get this kind of valuation, you have to have gold making new lows. So I love the risk reward setup. I've never seen like this before, and I think a big part of the reason, it reminds me of the late 90s, in that all the money is being sucked into AI stocks and technology stocks. All the market's attention is over there, and people are not seeing the incredible fundamental shift we're seeing in the gold sector happening right before our eyes. So for me, you have all the benefit of the upside with much less risk because the gold price is so robust right now. So that's a setup I have not seen before, and that's why I've put the vast majority of my personal net worth into gold-related equities the last several years.
Yeah, that's a good take. Always, because I'm in the business for over 20 years, 25 years, pretty much, and I've seen some ups and downs. And I remember the last cycle and the last peak, I call it. And I think you're in the Formula Growth. At that time, 2011 was really the peak times. The valuations of the gold stocks, among other stocks, were really high, and then it sort of come back quite drastically for a couple of years at least. So remember those times, or how do you feel like? How do you mitigate those times when you're a portfolio manager or and part of the industry?
Yeah, I keep going back to my first lesson in the late 90s of being contrarian. So I was fortunate in the later stages of that gold bull market, 2010, 2011, towards the end of the bull market in 2012. I didn't own any gold equities. And the reason was the euphoria. If you talk to taxi drivers in Toronto or New York, they all own gold stocks back then. It was on the tips of everybody's tongue, right? So for me as a contrarian, especially in the commodity sector, when everybody owns it, everybody's talking about it, everybody's interested in buying it, that's typically the end. So I bought gold stocks in the late 90s. I bought oil and gas stocks in the late 90s when they were very much out of favor. And then when the gold sector crashed in 2012, 2013, 2014, I re-engaged with the gold sector in 2015. I remember the gold price was $1,100 an ounce. People said it was going to go below 1,000, that it was a barbarous relic, that nobody cared about gold anymore. That's when I started doing research on the gold companies again. So I like to be, when the investor interest is very, very low or apathetic, that's when I try to get involved and try to time my entry points in that way. It's not always perfect, but it does definitely take a lot of risk off the table. And if you're the first one to be buying a stock, yeah, the worst case, you have to be patient. Maybe you lose a bit of money for 6 months or a year, but all the other investors are ready to come to you. When they do come to the sector, you have very good returns. Where if you're the last one in, oftentimes you can have some negative outcomes like some investors had in 2011, 2012. But I think we're still, to me, very, very early. I'd say we're in the first or second inning of, especially the junior resource stocks that I'm involved in, first, second inning of that cycle, because they've yet to really start moving and yet to get any recognition by the market.
Yeah, as a follow-up to that, I think that time, not only the commodities metals price crash, but also there's a lot of talk of investors losing confidence because let's say all these even big mining companies, they're overpaying acquisition targets, they're mismanagement during the peak time. Do you believe the mining companies now at this stage of the cycle has learned their lessons and become more disciplined in terms of operating?
Yeah, absolutely. There's nothing like a near-death experience, Gilbert, to get you back in shape. It's like if you have a real serious health issue, you start going to the gym, maybe eating better. Same thing for these mining companies. In 2015, some of the biggest companies in the world, remember Teck and Barrick were all-out liquidity crises. They were back, but Teck and Barrick were selling assets at fire sale prices. Their balance sheets are upside down because when the gold price was strong, they borrowed a lot of money. As you mentioned, to do M&A, they levered up to do acquisitions. They overpaid for those acquisitions. And then when the price fell, they had the debt doesn't go away, but your cash flow goes down, and you had a very upside down balance sheet situation for many of the big major companies. So if you look what's happened since 2015 to 2025, the last 10 years, Gilbert, most of the big mining companies have been focused on paying down their debt, deleveraging, buying back stock, squeezing efficiencies out of their operations, selling non-core assets. So yes, they have definitely got the message. If anything, Gilbert, and part of it's feeding my bullishness on the junior resource sector, the pendulum swung too far the other way. So they've been so stingy about doing acquisitions, so reluctant to do acquisitions, that their cupboards are bare. If you think about the mining business, Gilbert, you might have an 8 to 10 year reserve life for most senior mining companies. If you do no acquisitions, you don't do any exploration, you don't refill the pipeline of new ounces, which you have a lot of good companies here in your conference that can do that, then your risk of having production fall off in the subsequent years is very high if you're not replacing the gold that you're producing. So if anything, that austerity or that conservatism has gone too far, and I'm forecasting a wave of M&A. I think more disciplined M&A, but these companies have to be buyers. The other thing I'd say is the valuations in the sector right now are very, very low. In 2011, stocks trading at 1.5, 1.7 times NAV and an asset value. Today, stocks are trading from anywhere from 0.2 to 0.8. Maybe if you're lucky, you get 1 times NAV. So the acquisition prices for those companies who want to start reinvesting in acquisitions are much lower and should be much more accretive to buyers. So yes, the industry's got the message. If anything, they've gone too far. And I'm forecasting maybe a swing back to the middle where you do smart M&A, do acquisitions, recognize the fact that you're in a depleting business. And if you don't buy something, you're going to have a problem 10, 15 years down the road.
Yeah, and further with that, because I listened to some of your interviews as well. You're a portfolio manager. You attended some of these bigger conferences. You have access to the bigger cap companies in the gold industry. With right now gold price over 3,000. Let's say we stay in 3,000 level for a little bit of time here, and does pretty much every gold mine out there is profitable in the world, and how are they gonna printing cash flow? They're pretty much doing free cash flow, tons of free cash flow. Are they try to use the free cash flow to try to do more acquisition, as you just mentioned?
Yeah, I mean, you're right, Gilbert. If you're not making money today's gold prices, you probably shouldn't have your mind not be open at this point in time at $3,000 gold. One of my key themes, you're right, Gilbert, interviews I've been doing publicly has been the margin expansion that the gold sector is going to see is astronomical. If you look at, let's say, 6 to 7 quarters ago, gold price was $2,000 an ounce. Maybe the average cost industry is $1,500, $1,600 an ounce. So they're making $400 margins, right? Today, at $3,000 gold, those cash margins have gone from $400 an ounce to $1,400 an ounce, 300% increase or more in margins. I don't care what sector you're looking at, Gilbert. If you tell me you have a sector where their margins are going up by 300%, usually the equity values follow strongly beyond that, and the stocks have yet to really even get back to the old highs from COVID. Many of these stocks, right? So yes, the companies are making money hand over fist. The free cash flow yield, Tavi Costa Prescott does very good work as well. He showed a graph a couple of weeks ago on his LinkedIn account that the free cash flow yield of the gold sector is higher than the technology sector. I would not get many of your investors on this call that would know that, but that's actually factually correct. And the free cash flows are increasing quarter over quarter as the margins continue to expand. So, the free cash flow yield for some of the mid-tier producers I look at, maybe the $2 billion to $5 billion market caps, if you look out to 2026, anywhere from 20 to 50% free cash flow yields. Those are incredible numbers. So that's why I'm also a believer you're going to see more M&A as these companies, use their cash. Most of their balance sheets are debt free. They have net cash on the balance sheet. Start redeploying some of that free cash flow into acquisitions, stock buybacks, and dividends. That'll continue to attract more investors to the sector.
Yeah, so you mentioned that we're probably the second inning of this cycle. So do you think it's a once in a lifetime chance now for investors? Let's say the people tune in today, they missed the first inning. Is it still got time they can get into the market and make some good money here in this cycle?
Yeah, if you look at the developers, Gilbert, so the pre-production companies, which you have at your conference, the developers, the companies that own resources, the exploration companies, I would say I've followed the sector for 25 years. These stocks are trading at 25-year valuation lows, despite the fact that the gold companies are making money hand over fist, the producers, and despite the fact that gold's making new all-time high. So it really is a once-in-a-generation opportunity from an investment perspective. Like I said, I was investing in gold in 2015. Last time I saw a valuation like this, gold was $1,100 an ounce, and the industry was almost going bankrupt. So usually to get this kind of valuations, you have to be in a distressed situation. So to see these kind of valuations juxtaposed against really robust fundamentals is very, very rare. Very, very opportunity. So yeah, that's why, I put my money where my mouth is. The majority of my net worth is invested in, resource development stories and some single asset producers in the gold sector.
So let's spend a bit of time talking about more on the micro level on how you invest into certain companies, because you look at tons of companies, I presume. So what will catch your eye first? Is it the project, the management, or the focus, the metals focus? Let's say if you like gold and silver really much, then you just look at gold first. What kind of scenario are we talking about? What sort of a process?
Yeah, that's a great question. I have a checklist, and I've actually done a presentation on this. It's about a 30-minute presentation where I walk through in detail what I'm looking for in a junior mining investment. I won't do the 30-minute, I'll do the 30-second summary for your viewers here today. But there's basically 6 things that I look for. Grade, so the higher the grade, the better your margins. Scale, so the more volume of gold or silver or copper that you have, the longer mine life you're going to have, the more volume of cash flow you're going to have over the life of the mine. Infrastructure, do you have a lot of infrastructure, roads, power, ports, existing mills, towns in place that can dramatically lower your investment cost to build a mine? So that's very important. Jurisdiction, is it a place where you're able to build a mine politically? Do you have the political support? And that's getting better in the US and Canada, as we've seen recently. That's good, but some parts of Canada and US are still hard to work in. Management, and I could talk for hours on management, but quality management and what does that mean to me? We could talk about that maybe another time. And then finally, valuation. So what I pay for something will determine the multiples on my money I can make if I'm right. So I'm very sensitive about the valuation I'm paying, which is why I like to invest when sentiment is low. You get better valuation. So those 6 things are my checklist. And obviously I have lots of details on each of those 6 things that I go into detail when I make an investment. And you're right, I look at hundreds, if not thousands, of junior mining investments, and I own 25. So to me, it's a volume game. You look at many cards, you look at many companies, and the ones that are really obvious will stand out much better if you're looking at a lot of different companies to compare and contrast the quality.
Yeah, you just mentioned 6 things, and one of the things that caught my eye is the scale. You talk about the scale, but in some of the times before, let's take a copper porphyry project, let's say. So sometimes people worry that the scale is maybe too large, that they couldn't get the financing because it can cost $1 billion to put into to start the whole process, right? Constructions and production. So what's your comment on that one?
Yeah, so for me, scale and infrastructure go hand in hand. So if you think about a big copper project or a gold project, you have some examples of the companies that I own here today, Northisle, Radisson, Northern Superior, American Pacific. These are companies that are presenting at your conference today that I'm quite bullish on. Most of them have excellent jurisdiction, excellent scale. What does that mean? If there's already a highway to your site, if there's already power in place, if there's already roads and camps and existing milling infrastructure, that can lower your capex by hundreds of millions of dollars, if not billions of dollars. If you make a discovery in the middle of northern Quebec or northern Ontario or northern BC, and you're 500 kilometers away from a road and there's no power, what that means is you got to find maybe 10 or 20 million ounces of gold to justify all the money put in to build the infrastructure there. Or if you find something in Quebec in a more mining friendly distriction, or BC where there's already a camp and a mining camp already, then you can share that infrastructure that's already been put in place to dramatically lower your costs. You're also right, Gilbert, that there is a preference in the market right now for projects that have a more feasible capital cost. So these multi-billion-dollar capex projects, there's only a few companies in the world that can finance a project that big. Whereas the capital cost between 200 million and say $800 million Canadian or US, those are more manageable projects that many more companies can finance, and therefore the attractiveness of those companies are better. But there will come a time in the cycle, Gilbert, where the bigger mega projects will get a good bid because there'll be a desperate scramble for material metals, and big will be beautiful. But right now, mid-size, small is a little bit more attractive to the market because the market can believe the financing is a doable thing.
So what sort of return are we talking about? Are you looking for when you decide, let's say, okay, this is the project, this is the company I'd like to invest. What sort of time frame and in sort of return are you looking for usually?
Yeah, it's something I think about a lot, Gilbert. I would say, I'm not sure how many of your viewers of the conference here today invest in technology venture capital funds, but VC investing has been very, very popular in the technology sector. That model is basically you buy 25, 30 tech startup companies, 25 to 27 of them go to zero. But if you find one Google or one Facebook or one Netflix, you make so much money on that one investment that you earn an amazing return overall on your whole portfolio. I liken junior resource mining or energy investing to a venture capital portfolio. That's why I own 25 to 30 names. I typically put 1% of my portfolio in a new investment, and I'm looking to make 20 to 50 times, 20 to 50 times my money if I'm right, because I know in advance, despite the amount of work that I do, the expertise that I have in the sector, that many of my investments that I make in these early stage companies are not going to work out. Some of them will go to zero. So I have to make a very large return when I'm right to subsidize or pay for the mistakes I'm going to make, because very few companies can go all the way to become a mine. But the ones that do, 30, 50, 100 times your money is not an unusual return. So I always tell investors, don't just buy one junior resource stock. Buy a portfolio of names, be systematic in your approach, be willing to take risk, understand that some are not going to work out. If you focus on the valuation, the entry point, and the return you can make if you're right, I've had been blessed to have many 30, 50, 100 times my money stocks in my portfolio over my career. And I tell you, once you have one, you're addicted. You want to find another one. And it also pays for a lot of mistakes that don't go to 100 times your money. So that's really the approach that I use, and very disciplined about it and very calm about it as well, in terms of being systematic and have a strategy in place to do it sustainably over time.
That's indeed a great approach. So I will probably ask you this as a follow-up. You talk about Netflix and Google. Have you found your Google and Netflix yet? And a story that you can brag about, 10 years from now, talk to your grandkids about this is the one story that I invested early and make me that star.
Yeah, I mean, I've had it's hard to pick among your children. You never know who's going to be Google and Facebook. I have some companies that I invested in that I have high hopes that will do that. But in the past, I've had couple oil and gas companies. A company called Heritage Oil went from $3 to 100.
Wow.
Richmond Mining, we got in, I think 50 cents. It went to $15. K92 Mining, I bought it at 45 cents. It's $12 today, and I still think it's got a lot of room to run. Many other juniors I've invested in recently have gone up 10, 20 times. There's also a lot of mistakes I could talk about. In all humility, I don't get them all right, obviously. But yeah, when I'm making those investments, 1% of my portfolio, my expectation and my hope is that some go 20, 50, 100 times my money. And typically what I do, Gilbert, is if the company's doing well and executing and showing signs that it could become a mine, I'll increase my investment in subsequent financings, get up to 2, 3, 5, 10% of my portfolio. You kind of got to water the flowers, they say, and pull out the weeds, right? So some of the weeds are going to have to throw them in the garbage, but the flowers start to blossom are the ones you want to fertilize and give more water, let them grow into be these large companies, large successes that some of these companies can become.
So I talk about the good things. So let's talk about the biggest mistake so far you have made in your career. If you're being honest here, for sure, we'd like to share this story with our audience, because without making, just like Michael Jordan, right? You gotta miss a lot of chances before you're hitting all these buzzer beaters. So what will be the biggest mistake that you made that you remember that you can always learn from it?
I taught for 10 years at the university near my office in Montreal here. And I told my students when I was teaching at night, taught the night classes, to give back to the community. I said, you got to start investing your money right away. And I said, I hope you guys all lose money. And they said, oh, sir, you're so mean. Why you want to do this? I said, no, because when you lose money in a stock, you learn 20 times more than when you make money in a stock. When you make money in a stock, you think you're really smart. When you lose money in the stock, it hurts. And if you're smart, you take your time to look at what's the mistake I made? How do I get better from this? So I view all my losing investments have been one of the greatest contributors to my success, because I've learned from each one. And hopefully you don't repeat the same mistake more than 2 or 3 times until you learn not to do it again. So a lot of the criteria I have for investing in junior mining stocks have come out of not paying attention to those things and losing money. I'd say a couple of mistakes I've made in particular, investing with too much margin. So borrowing too much money to invest and having the market go down on you and being forced to sell stocks, even though you love them, because the market's under pressure and the bank is calling you, telling you got to repay your loan. So I've learned to lower my leverage over time, investing in the stock market. And a second one I would say, that's where I've really fine-tuned my contrarian streak, is investing in a commodity where I have a negative outlook of the commodity. So if I think that oil is going down, or copper is going down, or silver is going down, and I own stocks in that sector, that's my view, the commodity is going down a lot. You don't want to own any stocks in that sector. When a commodity is going down a lot, it's almost impossible to make money in that stock. So you might fall in love with your companies and just say, I love company XYZ, I love this company. But if you think the commodity is going to go against you, it's like kind of like running a marathon with the wind blowing in your face. It's very hard to run. It's the same thing. So that's why I try to position myself in sectors that are on the upswing in the commodity space, which is the wind at your back. It's a lot easier to run. So those are two lessons among many, many lessons I've learned over the years in terms of losing money.
Yeah, we've got a bit, running a bit over a few minutes, but I'll conclude this with one last question to you. You talk about all these great lessons that you've learned. Is there any like mentor or anybody you look up to during your career that give you advice that you always remember? Because now you're sharing your insights with us, and people, of course, look up to you for advices too, right? So anybody that that have helped you the most?
Yeah, I'd say my first mentor in the business was a man named John Dobson. He was actually the founder of the company I worked at, Formula Growth. Very successful guy, very humble guy, very generous as well. So I learned a lot from him socially and how to do good with the wealth you create in this business. But on the finance side, he gave me advice I never forget. He said, Michael, surround yourself with people that are smarter than you. So he was always very comfortable not being the smartest guy in the room. He had incredible networks of people around him that advised him. He invested in small cap growth companies in all sectors. So he knew experts in every single industry in America. He invested mainly in the US. So he knew the best auto parts guy, the best aerospace guy, the best banking analyst. And he would always say, look, this stock looks good, but let me call someone that's even smarter than me, an expert in that domain, so that I can get that extra knowledge to make an even better decision. So as I've invested in the commodity sector, I'm not a geologist. I've never built a mine in my career. So I surround myself with geologists, mining engineers, metallurgists that I really respect. When I find an investment that to me looks really attractive, I always call them to vet it and say, look, this looks good to me, but in your professional opinion, is there any red flags? I think I'm missing that could cause this investment to be a loser. And that's keeps me in a lot of trouble too. Some people want to be the smartest person in the room, don't want to take advice from anybody. I'm very willing to find the smartest people that I can find and ask them to advise me on how to make better decisions. So that's something that I think it's free. Most time people are willing to share their knowledge and are very helpful. So that's something I've tried to do and build a really good network of people that can advise me to make me better at what I do.
Great. And thank you for being here to share your good knowledge with us here at this conference.
My pleasure. It's a lot of fun. Thank you, Gilbert.